What is the real value of Coca-Cola? In today's video, we are going to look at it and think about how to value Coca-Cola as a company, as a stock. On what price should I buy it? What is it worth? Is the dividend good enough? Or how should I value this company in general? We sort of know that you can value a company based on its assets, for example. You can value a company on the cash flows it's going to provide you over time. But we are going to take an overall picture about Coca-Cola, which is running on the ticker symbol KO. So you will get the stock. And if you would like to know more information, make sure to check out the description of this video. And in this video, we are going to make the analysis in my Google Sheets, which you can get if you click on the description also. And if you plug in the ticker symbol to the system, it will automatically load in all the data in regards of the company. So you will get the income statement, you will get the balance sheet, the cash flow statement, and all the ratios within a 10 years range. Of course, if the company has not lived this long, you won't get the data. But for this case, we have plenty of data since Coca-Cola has been a significantly great growing company with a nice dividend. So before we head into the main three statements, I would like to have a quick look at in the company's financial statements, just to get a clear picture. So Coca-Cola is trading on a 24p ratio, almost 25, which could be a high price to earnings ratio. You would probably prefer to get around 10, 15, or in the beginning of the 20s. But 25 could mean that it's a little bit overpriced in this sense. And also you can see that their profit margin is almost 24%. It's more closer to 23, but their profit margins are 23%, which is a good indicator if you would like to compare Pepsi, for example, with Coca-Cola. So you would just swap the ticker symbol on the top and you could easily compare the two profit margins for the two separate companies. For the current ratio, you could ask, what is the current ratio? Basically, it's the current assets divided by the current liabilities. And if the number is higher than 1, you should be in a green zone, so it's good. So this means that the company's current health situation is good. So if the number is above 1, that should be great for a healthy company. The debt per equity ratio and the long-term debt per equity ratio should be getting to the lower amounts. You would prefer if a company has lower debts versus their equity. But of course, this needs more check-in to their balance sheet in regards what type of debt they have, what type of interest they have to pay on those debts, and etc. So the other thing which we have to look at is the price to free cash flow ratio, which could be very similar to the price to earnings ratio. One of them, the price to earnings ratio, looks at the profitability or the net income of the company, and the other one is focusing more on the free cash flow that the company is producing. I would prefer the price to free cash flow as it shows a more clear picture. And of course, I would prefer if the price to free cash flow in case of Coca-Cola would be lower. But of course, I think 27 is about a little bit overvalued or overvalued. And if we look at their dividends, we see that Coca-Cola has been paying out dividends for a long time and they have been raising it from year to year. So it's a great stock in regards of dividend payments, but dividend is not everything. I will have to say it very loudly. Their payout ratio is quite high, which could be usual in a company like Coca-Cola, since it has been having a lot of market share. There is not that much space to grow in, so they would rather pay out the money, the earnings to their shareholders instead of reinvesting into the company, which could be normally understood. And this is why many people are still choosing Coca-Cola, because it pays out a nice dividend overall. So their dividend yield is currently at 3%. It's usually around that area. Of course, if you're a dividend investor and you would like to always put back your money after you get the dividends, Coca-Cola could be a right choice in regards of that dividends is something that you earn. It's a free cash flow if you would look at, and maybe a growth stock is not offering a dividends which you would like to have. If we look at their profitability, return on assets, return on equity, return on investments, this is very important when we look at, we want to make a difference between Coca-Cola and Pepsi, for example. Of course, the higher the numbers are there, that's greater in the total sense. But let's take a deeper dive into their income statement, and let's see what has been happening with the company over the 10 years period, so we can sort of make a forecast in a discounted cash flow model, because in this video we are going to make a discounted cash flow model and see what could be the real possible price of the company. In this Excel sheet you will also find the Benjamin Graham Institute valuation, Peter Lynch's valuation, and also a dividend discount model, and of course the discounted valuation model. So it could be a great tool to analyze certain stocks, and you see that their overall revenue hasn't been increasing as much in the last 10 years, which I said in the before, that this company is probably hitting its ceilings in their growth. And we can also see that their net income has been slightly increasing, which means that this company is becoming more and more profitable in that sense. Even though they couldn't raise their revenues, they could raise their margins in regards. So that means a higher net income at the end, which could be great for a stock. But what we really want to look at and what we will use is a free cash flow growth. You can see that Coca-Cola has been increasing its free cash flow growth. You have the right question in what is free cash flow. Free cash flow is basically cash from operations, and you take out capex from it, and then you will get free cash flow at the end. But of course, we can take a deeper dive into the cash flow statement if we would like to, but we will look at it when we are at the discounted cash flow model. I just want to have a quick look on the average price to earnings ratio the company has been trading on. And if we look at their 10-year average PE ratio, we can see that they are quite close to the average, so maybe even a little bit below. And this could be that there is in general a tech stock hype. So maybe Coca-Cola is being undervalued in these circumstances. I wouldn't call it undervalued. I would call it that it's fairly valued and maybe a little bit overpriced. But for some investors, it's a great investment, which I can understand. And if we look at their dividend yield, we can see that it's usually around the 3%, and their payout ratio is around 80%, which is totally understandable. Sometimes in 2017, you can see, for example, a higher number. You would need to check in more if you would like to invest in Coca-Cola, what happened in 2017, just to get an imagine of what is the management doing. But we can see that the management is targeting around 80%, which is an average if you would look at dividend paying stocks. But if we just go quickly through the Graham valuation, some things are still in Hungarian. I haven't fully translated it yet, but you get the picture because most of the key factors are in English. But basically, Benjamin Graham is the father of value investing. I have read his book. I have been influenced since I was a younger teenager in regards of value investing. So you have a revised version and the older one. The revised version could be more reasonable for the current situation, and everything is up to date. So you just have to plug in the stock ticker symbol and everything, every valuation, you will get it with the latest informations in regards to the corporate bond yield, for example. But we know that this valuation model is heavily depending on what is the corporate bond yield currently, which is quite high if you would look at the historical time lapse, but let's say that in regards of the revised version, we would have $17 as acceptable buy price in regards of Coca-Cola. And if we would look at Peter Lynch valuation model, which you have the formula here right now, you would get the picture that it's also very overvalued, in the sense of that its PE ratio, it's very high, and that pulls down the whole valuation because you just have to divide it by the end. But the most important is the discounted cash flow model. And discounted cash flow model, in short, basically you are going to take the last 10-year average growth rate of the free cash flow, and then you are going to forecast it for the future, which you will bring it back to the present value, because the money has a future value and a present value. So basically you take back the future value to the present value, and then you are going to adjust it with the current informations in the balance sheet. So what you need in a discounted cash flow model, first of all, you need the growth rate. We can see that their average growth rate was 3.8%. And I like to be very precise because I'm going to forecast it for the next 10 years. That means I have to make a number which I'm confident about every next year which is going to come, and I can revise it, of course. But why would I make a bold statement and say it's 11% growth when I know that Coca-Cola is not going to achieve? So here it's better to take a safer number, still closer to the 10-year average, but of course you have to take into account what happened in the last 3 years and what happened in the past 5 years to get a full picture. And for this reason, I'm going to adjust it only to 2%, which could be a very, very low estimate, although it's in the safe line. So I can revise it, for example, in the next year, if the 2024 data come out. Of course, it's going to take a year, but if I make an investment, I want to be confident. I want to make my decision very wisely. I don't want to make any discussion. I don't want to make any higher risk as I would. And basically, in regards of the discount rate, we are going to make the discount rate with the weighted average cost of capital. And the weighted average cost of capital, I usually use the 11%. Maybe it's the highest number, but on average, if you use 11% as the discount rate to take back the future values to the present value, I think you're on the safe side. But basically, you can see that inputting all the data, you just basically had to change the growth rate and the discount rate. You have to figure out these two numbers, and then everything is done automatically from there. And then you can see that the average price would be, or the discounted cash flow price would be 19.52, which is actually far below the current value. This would mean that actually the stock is overvalued in regards of the discounted cash flow model, which is extremely focusing in what money is the company able to make in regards of the free cash flow. But if I would adjust it to 3%, you wouldn't see a huge jump. So basically, to the current value of the company, the current stock price of the company is 61, very high. If I would have to put in a 10%, I would still not get that amount of valuation, which is the current price. And if I would decrease basically the discount rate to 8%, and with the 10% growth rate, I would be around the price. But I think this is a very optimistic calculation. Since the 10-year average growth rate of the cash flows have not exceeded 3.8%, then you have to be on the safe side still. So if I'm doing a more optimistic calculation, I still don't get this price which is currently trading on. And of course, since it's a high dividend paying stock, you can use the dividend discount model. And then just make sure to use the same amount of discount rates as you used it before, because it's important to stick with one calculation and then go with it until the end. And you would get that it's around 41. So my suggestion would be, I would be interested in Coca-Cola if it would be around 25, 30-ish. But since it's trading on much higher level, almost double of it, I wouldn't touch the company. I understand that it's a stable company in regards of the dividends. So if someone is in the higher age and looking for retirement, I think it could be a great opportunity. Of course, it's not a financial advice, but if someone wants to collect the free cash flow from a company through dividends, it could be a good choice. But for me, who I am looking for a longer term investment which would get me dividends and also great growth, I would pass on to Coca-Cola. And yes, I would love to know what you think. I would love to know what you think about the company, about their dividends. So make sure to let me know in the comment section. And also don't forget to subscribe for future analysis and put down the stock ticker that you would like to get analyzed in the future videos. I will make it, and don't forget to read the description, and you can get the fully English translated Google Sheets, and then it will be good for stock analysis. So see you in the next video. Don't forget to subscribe. Goodbye.